All righty. Welcome back to the Smart Investing Show. And this is the time that we talk about financial planning. For that, we turn to our financial planning expert, Harrison Johnson, CFP. Harrison, thanks for joining us today. How you doing?
I'm doing great.
I like this topic. Start Social Security early to invest. And I want you to explain that so people understand what we're talking about and why.
The reason why we brought this up, there's an article in the Wall Street Journal recently that kind of talks about this. So I wanted to give my input and reasoning behind that. But basically, this article in the Wall Street Journal is saying that, should you collect Social Security early so that you can invest that money, as opposed to waiting to defer Social Security to receive the higher income. So with Social Security, you can collect as early as 62. You can defer until 70. This article is saying that it's better to wait until 70. And the reasoning behind that is your age 70 benefit is about 77% higher per month than if you collect at 62. And by doing so, you're increasing your guaranteed income in retirement, where, collecting early to invest the money, which most people don't do that. If you collect early, what that means is you're just going to be withdrawing less from your investments. But by doing so, you're kind of by collecting Social Security early, you can preserve your own assets to a greater extent, and then those larger assets can then create income to offset the fact that your Social Security per month is less. So that's kind of the question: do we collect early or do we collect late? And again, the article is saying it's better to wait because it's a guaranteed source of income. It does, though, say, well, if you were to collect early and then that means you could invest the money or withdraw less from your portfolio. If you earn a reasonable rate of return, you do come out ahead in the long run, which I agree with. That's true. But it also says, but what if stocks go down and you lose 3% after inflation per year? That's not likely to happen, especially when you look at in here, it says if you retire, you're probably going to live to about 85 or so. So, people in their early 60s have a life expectancy of around 85. So from 62 to 85, that's 23 years. So the chances that you lose money over a 23-year span is extremely, extremely rare, especially when you factor that this calculation isn't about a lump sum. So it's not like you're investing everything right before the stock market potentially goes down. It's a monthly cash flow thing. And so you almost get the benefit of the dollar cost averaging of what that investment is. So I put together some numbers because
got to back it up.
You got to back it up. So essentially depends on what your portfolio is doing. If your portfolio is growing a lot, then collecting Social Security earlier so that you have more money that can be invested in growing, that's a good thing. But I have a couple different rate of returns. So if you earn 0%, so you keep money in a checking account or under a mattress or something, you're better off collecting Social Security at 62 if you live to about 78 or earlier. So if that's where you live, then you're better off collecting at 62. But again, that's with a 0% rate of return. If you can earn a 5% rate of return on average, now you're better off until a life expectancy of 84. If you have an 8% rate of return, then it's about 94. And if you can have a 10% on average return, you can live until infinity, and you will always come out ahead by collecting at 62.
So the longer you live, the better.
Well, yes.
Okay. That's
depending on the
right,
return,
number-wise,
because
return.
Obviously, if you die very early, then you want to collect Social Security early because you can get something. You don't want to wait until 70 and then die at 71, and you would have never received everything.
But with the compounding, you do better longer term.
With the compounding, you do better longer term, but ultimately you have to look at how you're going to be investing that money. Because again, when you go into retirement, you generally have Social Security on one side, that's an income source, and then you have your portfolio that you would draw from, and that's your other source. You're going to live, you're going to spend money, so it's a matter of how much are you getting from Social Security, how much are you getting from the investments. You start Social Security earlier, you withdraw less from your investments can grow more and create more income later. So what is that money doing? What rate of return is it growing at? If it's growing at 0%, then in many cases, collecting Social Security later would probably be better because your money's not working for you. But in the vast majority of cases, and what really should be happening is your money should always be working for you no matter what age you are. Right. So if you have a return on average of, let's say, around 8%, now, as long as you live between, up to age 94, you're better off collecting sooner. If you can make 10%, then you can live forever, and age 62 would be better.
Never run out. And the thing, too, that's important that you want to look at as well, like they've got to have the discipline to do it, to invest it. That's what worries me is somebody like they do it for a couple of years and like, oh, I want to buy a new car. I want to buy a boat. Whatever. It's like, well, that's not going to help you. So you got to be disciplined to do this. And then also, too, I mean, I just look at it for people that it makes sense if it's invested properly.
That's really what it comes down to. If you can be a good steward of capital, and we all should be trying to do that. This is a financial show. Hopefully that's the point of it.
That's what we try to get across.
That's what we're trying to get across. If we can be good with money, then getting money sooner from Social Security, not waiting 8 years of collecting nothing, gets us that capital so that we can use it. And again, that doesn't usually mean that you're collecting a Social Security check and then you're investing it right away. Usually you're getting that Social Security, you're spending it, and then you're not withdrawing as much from your investments. And if you can do that, more money stays in your portfolio. You have a larger amount of cash flow throughout your retirement, generally speaking. And then the other thing that's nice is that money gets inherited by your spouse or your kids, where Social Security is temporary. It stops when you die.
Builds the family wealth.
Builds the family wealth. Everyone always wants to do that. I want to build generational wealth. I want to, which is great. Well, don't, in many cases, deplete your assets to try and increase a temporary monthly benefit that's only going to last, until you die.
And he didn't mention that in the article, did he?
No. And I think that's the big flaw that people make is like, well, I get the guaranteed return on Social Security. You brought up this point already, but I want to reemphasize it. It's not growing a lump sum of money. It's not like you have $1 million in your 401k growing at 7-8%. That's not comparable to the benefit that you get on the Social Security. It's a cash flow stream that's growing for you, not an asset, not a lump sum, not a 401k. And that's what really changes the numbers equation, which Harrison tried to lay out here.
Yeah. Every year you wait on Social Security, the monthly amount increases by about 8%. So people will look at that and say, well, that means I'm getting an 8% return guaranteed by deferring. No, you are not, because you're also going to be receiving that larger amount for 1 year less. Because again, when you die, it stops. So by deferring, yes, the monthly dollar amount is increasing, but you're collecting that over then a shorter period of time. For the same reason, if you have money in a checking account that's earning nothing and you withdraw it evenly over 10 years, that amount that you can withdraw is going to be different as if you had withdrawn it over an 8-year period. If you only have 8 years to pull the money out, the annual amount is going to be larger. It's the same type of thing. That's an exaggeration, but that's why, deferring doesn't mean you're giving yourself an 8% return, because you're shortening the time span.
I just realized I'm not taking my Social Security. What am I doing?
So in your case...
Oh, here we go. It's not good for Brent.
No. It doesn't... Your spouse is younger than you. So in your case, she is going to get that amount when you pass.
Okay.
And today you went to her mom's birthday?
94th birthday.
Okay, so yeah. So she's younger than you, and she has longevity. So that means your Social Security amount is not just for the rest of your life, it's also the rest of hers. She should collect it as soon as she can. She's not there yet, but when she turns 62, that's going to be the time to collect. But in your case, we're not looking at the rest of your life. It's the rest of really her life. So that could be, 50 years or something.
And you bring up a very good point. This is why you have to talk to a financial planner that knows what they're talking about, because it's not 100% always this way. You brought up, well, no, not for you because of your younger wife. There can be so many other things. That's why you can't just do something and say, and I've heard this, well, Joe did it, so I did it. Like, you and Joe are different. So that's why a good fee-based financial planner is worth your weight in gold.
Right.
Although you're pretty heavy. Whoa. You're a big guy. I mean, you're what, 6'4"?
6'4", yeah. I've lost some weight lately. I only weigh right now like 210 pounds. I used to be like 235 when I was working out a lot.
Okay. All right. So, we'll move on from the weight comment. Well, good. Okay. Well, I think that was very helpful for people. I mean, again, and the thing they have to understand that and to give you a call because you got to know what you're doing.
Every situation is different.
Yeah.
This article, the reasoning that this article is making this stance, I don't really agree with, but there are situations where the advice of that is correct. There's also situations where the advice is wrong. It really comes down to how long is that benefit going to be received and what are you doing? What other rate of return are you earning on that money? If you're somebody who doesn't invest, you're probably better off waiting on Social Security. But I would say you should invest that money.
Yeah.
And if you can invest that money and if you can earn a rate of return, collect Social Security sooner to supplement that investment growth. And overall, that's an overall net benefit by going about it that way. In most cases, not
As
all
usual,
cases.
great information. Thank you, Harrison. All right, that again is Harrison Johnson. He is our CFP, our financial planner here at Wilsey Asset Management. He is a fee-based planner. He does not, sell you product or insurance or whatever. And again, you had a great topic where it's not always the same. And if you have a hammer, that's all you give. You got to sometimes use a screwdriver, different things. So you want a consultation with Harrison? It is free. Give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com.